Join our community on their wealth building journey with the Wealth Elevator. If you've been a listener of the Simple Passive Cashflow podcast since 2016, you witnessed my genesis buying little rental properties to now over $2.1 billion in assets as a general partner. Along the way, I uncovered a 3-step system. Step 1, syndicated deals, where you bid farewell to 401k plans with traditional investments and deceitful operators as you make your way into the alternative world. Say hello to genuine opportunities as I invest alongside you. Step 2, unlocking passive losses. Ditch those 401ks or Roth IRA strategies for the average Joes. Discover the secret tax strategies of the wealthy, where most of our clients are able to lower their tax bill by 20 to 50%. And finally, step 3, mastery of infinite banking by making money in 2 places at once. For those net worth who haven't hit 1 million, go into my free turnkey rental course at thewealthelevator.com/turnkey. Now let's get real. If you're an accredited investor who is searching through countless books and podcasts, my 1-2-3 system is your key. But remember, this journey is about a community of passive accredited investors like ours. Plug in, join our investor club, and unlock unparalleled investor access at thewealthelevator.com/club. And for those poised to deploy over $250,000 their first year, or got a net worth of over $2 million already, join our exclusive inner circle. The Family Office Ohana Mastermind awaits.
The whole premise behind the book is that there's different layers to wealth building. And my frustration over being in the personal finance blog sphere in my 20s and being a student of the game myself, there's all this financial advice out there. However, where does the strategies come into play based on where you're at? Burst strategy, saving your money, the latte a day kind of tactics, the fire tactics, and then some of the higher net worth strategies that we employ. There was never some kind of paradigm or structure put in place to let people know, hey, this made more sense at this point in the journey, and to not focus on this or that. So that was where, when we were putting together the book, this idea of this leveling up program, or at least telling the financial journey from the beginning, as the idea of like scaling a building, and then the ideal of an elevator being that construct to cheat code your way to higher levels of the building quicker, came together, and the wealth elevator became that construct. And it made more sense to rebrand around this idea, the wealth elevator being this kind of secret passage, this cheat code way of getting quicker through to financial independence. Yeah, so let's talk about the website a little bit. SimplePassiveCashflow.com is going to be going away, and it will be replaced with thewealthelevator.com. When I first created the website, my whole idea was to create this huge repository of information and articles. And then I started to create super articles like the syndication one, the taxes one, the cost seg one. There were more than a couple dozen of them. The whole idea was to, again, create this big repository. Unfortunately, a lot of the feedback you guys have given me is nobody is able to find the damn thing in this big pile. So I created a members page and an e-course kind of format. That didn't work either. It just became this big blob of information. With ChatGPT, blogs being less of a consumable media these days, a lot of it is just written by machines. Pretty soulless out there. The blogging format and the website with the whole bunch of articles, people don't got time for that, especially our investors, right? Most of our investors are busy working professionals, making multiple 6 figures with families. They don't have time to go dig through a website and read 500-word, 1,000-word plus articles. They want the quick, easy kind of path. Therefore, we structured the website around that to usher people into the new members website, or the new e-course format that's a lot more user-friendly, built off the same skeleton that a lot of e-courses are today. I still have the flexibility to, in the future, change things around, add the details I want. The whole point was to bring as many people on this wealth elevator journey as possible. And I didn't want that burden of being overwhelmed with a huge amount of content to get in the way of people getting what they need, progressing down the journey. Later on, you can read the details as you go along, as you're moving off on that path to financial independence. So what can you expect through this whole rebranding process? We're going to flip the switch
some point. And obviously, we expect there to be some issues coming out the gates. We've been testing in the background. If you notice, some pages have been down here or there. We want to make this process as seamless as possible. So the website will transition over to thewealthelevator.com. And those of you guys who are already members with us, who already have an account and have been playing around with the previous e-courses, you're going to see the new refreshed e-courses on the Wealth Elevator member site. For those of you guys who do not have an account yet, great time to get set up. Go to thewealthelevator.com/club, sign up for the quick form there, and then you can get access to all the content back there. So if you run into some problems, that's why we have the team here. All the emails will be moved over too. So instead of team@simplepassivecashflow.com or lane@simplepassivecashflow.com, it will obviously move over to team@thewealthelevator.com. And then my email address will be lane@thewealthelevator.com. One thing we pride ourselves is I'm a little old school in this kind of respect, where if you have any question, you're confused, right? I get it. Just pick up the phone and give us a call. 808-215-5531 is our team service line. Just reach out there and we'll point you in the right direction and get you reoriented with the websites. Those of you guys who are investors with us currently, those signing portals will be remaining the same. That's where you retrieve your K1s, you check your distributions. If anything changes in your address or your direct deposit accounts, you still change it on those websites. But thewealthelevator.com will be that blog and central website that a lot of people will be coming to on the public side. And then once you are a part of our group, that's where you have your account at the members part of thewealthelevator.com. And then also just a little bit about thewealthelevator.com, the public website page. We're going to be tinkering around with the format there. Nowadays, we have the weekly investor news updates that go out. What I've realized is there are very big super pages I have, like thewealthelevator.com/syndication, great example, or thewealthelevator.com/start for the people just starting out with this stuff. Great page to refer your friends to if they're just totally new to this type of stuff. We'll be continuing to update those particular pages. With the way that we get you on the path to financial freedom, we hammer out these topics and we want to try and make it as concise as possible. But there's a point of saturation that we're getting to with some of these topics. I wanted to make a channel where I am able to write about some of my observations in the world, my intellectual musings, and put it on that blog page too. Creating these new channels is going to be a way for me to satisfy the people getting that main content, and then people who've been around within our community for years to get that extra content on the side there. Because after you're at financial freedom or you're on that path, on the rails, moving there, it takes a while, right? This is not the get rich quick scheme here, but maybe you like to read up on a few financial musings on the blog side. As far as the social media channels, if you guys are already following us on LinkedIn, Facebook, Instagram, YouTube, all those channels will be switched over seamlessly. If you aren't following us on there, follow us. It's going to be a lot more cooler stuff. More short-term content is what we're going to be putting out there. We're going to be taking the long-form content that we've been known for within the podcast and the YouTube webinars, and we're going to be teasing out the highlights of those sections. I don't know why, but it just seems like everybody is more into these shorter form, snackable contents. I guess even myself scrolling on those YouTube shorts a little bit too much, but check those out too. So again, why are we doing all this website, social media rebrand and everything? Because again, the book is coming out later on this year. Editors have told me it's somewhere around October, November timeframe. Originally, we were going for 120 page. When I got it all said and done, it was almost 200 pages. But I think everything in there is really what I want there to be. I've heard from a lot of you guys. You guys read a lot of these fluff books out there where maybe at the most people will talk about, oh yeah, and syndications. Once you get there, that's the golden ticket, right? And that's it. Maybe there's a paragraph on it. But we're going to be deep diving into syndication, private placements, the taxes, accredited investor banking, how it's superior to infinite banking. We're going to be talking about like different strategies when you get to $5-10 million plus. I think a lot of you guys are going to find those really cool, right? It'll be at that point a little bit of a free for all at the end of the book of all these kind of unique plays that are open to very high net worth individuals. Now, if you're starting out under $1 million net worth and you're buying little rental properties, it kind of overlays the steps that you need to do mentally. Buying properties in your own backyard,
then expanding remotely and then scaling from there and then transitioning to syndications and private placements, which is on that second floor of the wealth elevator construct. It's going to be a very detailed book, and it's going to be talking about the transition that a lot of our investors are making when they're coming into the world of alternative investments. They're typically coming in with about 10 to 20% of their net worth, and they wait for 2 to 5 years until they see their projects go full cycle. Then they make that second push and maybe expand to 20, 40, 50% plus of alternative investments. And how does that really play with their taxes, right? Obviously, the more alternative investments you have, the more passive income you have and less ordinary income. And we get into those details and we get into the real transition of this all. So where you are in this journey, I think it'll pick up to where you were and then where you are now. And then they'll definitely go past that 5-10 million net worth amount to outline where you will be. Super excited about this because there's nothing else written out there like this. And it's going to really serve as a base for future content that comes out on our members page and e-course. So if you guys haven't gotten access to the members pages, which is the e-courses section of the website, we have a lot of free content in there. Of course, just to name a few, for those of you guys who are interested in infinite banking, accredited investor banking, we have the e-course there. I think that one's about a few hours long. We have the basic intro into the private placements and syndication deals. And then for those investors who've jumped on onboarding call, we have the syndication LPE course, which I would say we've always been expanding it. I think it might be about 10, 12 hours of content in there, but really specific for passive investors doing due diligence and learning about the deals that they're going into so they can look at the right things within the deal. And then we have the basic financial literacy course. That's great for the younger people and the people under maybe $250,000 net worth, or maybe if your kids are interested in it. But I think most people come to the website for turnkey rentals or syndications and private placements once you become accredited investors. I think a lot of you guys have been referring your friends. We still have that program set up where if you guys refer a friend, we connect them with and give them access to the e-course that makes the most sense for them. Part of that is so you guys don't have to waste your time talking to them. I have a lot of friends that I've talked all this stuff to over the last decade, and some of them don't do anything, and it frustrates me. And just like I'm sure it frustrates you. How do you save your time? Well, just connect your friend with us via email and we'll get them set up so that they can do the right e-course. And then now they can have much more powerful, meaningful conversations with yourself. The wealthelevator.com website is going to be coming up. I think one big fear that some people have is I'm somehow replacing myself with a bunch of cartoon characters and my staff. No, that's not happening here. I think it's just an attempt to rebrand to where the book is and then build upon that. I've been an avid blog reader myself for well over the last decade, and I've seen some websites out there being bought out by private equity where they turn the website, the content website, into a monstrosity of ads and the content gets really lame. That ain't happening here. I still own 100% of all my content and still have 100% creative direction on it. Of course, now we have a lot of team members that help me out and package up the information for you guys to consume better. But it's nothing like where there's a site takeover and the website and the brand kind of deteriorates over the years. Not the case, I think. But help me out if you guys have any feedback or want to see the project go in a different direction. We've always prided ourselves on having a great community. How can we make this better for you guys? This whole mission was a way to educate the next generation. Unfortunately, I've tried to go to my high school and different colleges, and nobody wants to hear about the type of wealth building tactics that we do because it's a little bit too out there. It fights with the mainstream financial advice of invest in the 401ks and the traditional investments, the Wall Street investments. And we all know the reason why the mainstream wants us to do that. But how do we teach the next generation to invest in this way, to work their taxes in this fashion, to create their own family vault with accredited investor banking, and to invest in projects off of Wall Street? That's the whole point, to create this repository of information for people seeking this out. at the end of the day, this is the way I've found meeting within my life to create this type of access for people who want it to get it. I know a lot of you guys who are listening, obviously this resonates with you. Feel free to share it forward, connect us with people, and then we can get them set up with their site access. We'll even hook them up with additional free content there within the members pages. I think the whole idea is to get this information out there to people who are open-minded to it. And of course, as I always say, take everything with a grain of salt, think for yourself. But when you get the whole suite of information here, the big picture comes together. Again, I think if you're somebody who's a little overwhelmed by all the websites, what I would highly suggest is grab a copy of the book. It's a big, beefy book, but I think it's something where it's all in one place. Now, if that doesn't work for you and you want to see me in person via 100+ slide deck, that's another option too. We'll still probably do the events every year, the Hawaii retreat. But again, check out the book. The book will have all the little details in there that I think might get lost within the cuts and the videos and the e-courses, or just maybe supply a different angle of explanation into why we do these types of things.
Welcome to another episode of the Wealth Elevator podcast. Today, we are going to transition from the basement floor to floor one. This is where we cater to the small investor looking to climb the ladder to financial freedom. If your net worth ranges from $50,000 to $500,000 and your monthly cash flow hovers between $0 to $5,000 a month, and I'm talking about the net there, which is your income minus your expenses, you're in the right place. On this first floor, it's all about being a savvy saver and a strategic buyer. Pretty much good money mindset and values. Take my story as an example. So fresh out of college in 2007, I started my career as an engineer. I got paid pretty well, but still living pretty frugally and saving aggressively. I managed to save nearly $100,000 annually, thanks to a stint as a traveling employee with minimal personal expenses. Basically, I just lived off the company dime. I lived in hotels, and I pretty much used my corporate card for all my meals and then some. But a lot of this came from the way my parents taught me how to save my money, not buy things I didn't need to. We would never go out to eat at restaurants, and when we did, we never bought soft drinks. So we were those kinds of people. But the key thing here is most people are not like this profile that are good savers. And that's cool if you're not, right? Like, I think there are great options out there for folks becoming better savers or trying to have a freaking budget, right? Now, the thing here is moving away from the traditional investing mindset of investing in the 401k and all the traditional investments that aren't really that great returns because they have a lot of fees, hidden fees built in, and they don't give you the tax benefits that you do with real estate. So the key here is diverting the money that would have gone to those traditional investments and putting it to down payments on rental properties. Why? Well, in the first floor, we want to acquire alternative assets, and a great starter alternative asset is a simple rental property. Now, there are 4 big reasons why you want to own rental property. The first being the cash flow that you get, then the appreciation, the tax benefits, the ability to leverage. And I break down a lot of the math that isn't really good to show in a podcast form, but check out the YouTube video article that we have at thewealthelevator.com/turnkey and learn more about it there from a numbers perspective. But, follow me here, right? Rental properties is what you want to be doing on the floor one. And you're beginning to be a little scrappy with your income and cutting other unnecessary expenses. And from what I've seen from clients, because I saw it with myself, I was a pretty good saver. But once I bought one little rental property that maybe was $20,000, $30,000 down payment to buy a $100,000 house, that one little rental property, after all expenses and paying off the mortgage, insurance, taxes, put in an extra $200-$300 of extra cash flow a month. So there was a huge correlation between me saving 20, 30 grand and putting an extra $200-$300 in my pocket, or $3,000 a year. It actually motivated even more to sort of tighten up the belt in terms of finances and save even more money. And if you're listening to this podcast, you're probably a little bit of a financial fanatic too.
I think you kind of understand what I'm saying, right? Like a lot of this stuff that we do is fun, it's motivating, and it can also go on the side of pretty addicting, right? And you can imagine early on in 2009 was when I bought my first rental property. I was like, whoa, this is the coolest thing, right? The money that I made from that first rental property, which was code profits and cash flow at that point at the end of the month, you add that up, and I was like, well, that was kind of what I was striving to get that next promotion, to get that $5,000 promotion. And here I just gave myself a promotion. Wow, this is cool. I'm addicted to this stuff. I just need to save more money. And to me, I think this is the sad part, right? A lot of people just never get even past the basement stage to this floor one stage. Most people just can't save $5,000, $10,000 a month to even get on this type of escalator of wealth building here. Rental properties, you've got to deal with tenants. I'm a big advocate for getting professional property management to do your dirty work for you. But still, you're going to face challenges like the property maintenance and occasionally difficult tenants. When I had my portfolio, I usually lost money on 1 out of 3 rentals every year, which, if you're a very conservative investor, you may not be super comfortable with that. But I diversified, having 11 rentals, which I acquired from 2009 to 2015. That obviously augmented the amount of passive cash flow I did, almost a few $1,000s every single month. But more importantly, it got me diversification. So if I had a tenant that moved out, trashed the property, yeah, it sucked, but we'd kind of pick it up for a couple months when the whole portfolio kind of churns. A lot of our clients these days are already accredited investors, already in their 40s, have been saving for a decade or two already, and skip over this first floor of wealth building, which is namely buying a single family home rental, putting it into operation, working with property managers, dealing with the nonsense of repairs and vendors and tenants. I always think that this stuff is great to know. And unfortunately, a lot of our kids, with us being either the first or second generation millionaires, will never have to do, which I also call this the adolescence of investing, because who really enjoyed going through puberty and adolescence, right? But this is where you learn about accepting risks, going through ups and downs. It makes you a little bit more robust investor. And it also makes you appreciate it more when all this stuff eventually does start to get traction and you get to that second, third floor penthouse, which we'll get more in the coming weeks here on the podcast. It's something I think about a lot of times, having a kid myself, and I think it'll be kind of a constant theme you'll see in future podcasts, as we do have a lot of people within our family office Ohana Mastermind, our mastermind group, where they have younger kids, adult children too, and it's all about educating the next generation about this stuff. So even if you're coming in as an accredited investor, just going to invest in syndications and private placements, which we'll talk about more next week, having this foundation of grinding it, going through the first floor, saving maybe a few $1,000s to $6,000 every month. If months go by and your net worth goes up, Christmas comes around, you pay for some vacation, it goes down, you get knocked down. But, it's this slow grind where, you look up at the end of the year, and if you're in the first floor, you're able to save $5,000 a month. And then you look up at the end of the year and you've increased that delta, and now you're saving $20,000 to $50,000 per month. And now you're really starting to get going. Most of our accredited investors are able to save anywhere from $50,000 to $100,000 plus every single year, which powers their investing even more. But the important thing on this first floor, it doesn't matter where you're at right now. This is all a journey, right? And I think that this is the hardest part of the journey, and this is the thing that takes the longest. A lot of people think that this happened overnight for me, but they fail to remember that I graduated in 2007, just started working, bought the first rental in 2009, and then 2010, 11, 12, 13, 14, 15. A lot of years later, watching grass grow. Then I had a pretty decent portfolio of 11 rental properties. But then at that point, I was probably in the second floor of the wealth elevator, starting to invest in syndications and private placements. Nowhere near where I wanted to be, right? But what I'm trying to say is it takes a while. Don't get discouraged. Some other alternative investments that some people consider that are like Airbnb, short-term rentals. I don't really suggest these types of properties, even though they're very popular. The reason being is they are really discretionary spending items for people, right? They are vacation properties. When people go on vacation, they use these types of assets. But in recessions, people stop going on vacations, right? So I always like to base my investment thesis off of things that the general public uses and performs well in recessions, which is most of my portfolio is somewhere in this workforce housing, you know, long-term rentals for the average blue collar or lower middle class worker, somewhere between like average rents between $700 a month to $1,400 a month. Might be a little bit low from your standards out there, but this is, I think, where the majority of the potential clients out there. And in recessions, I think what happens is people living in nice luxury homes downgrade to more value-based living options. And I think this is where we kind of, are situated. And now you're seeing why I don't want to invest in vacation homes. Other alternative investments can be brick and mortar businesses, virtual businesses, things that you can value add and eventually exit or use the cash flow you get from that to go and buy other alternative assets such as real estate. Again, I keep coming back to real estate because it is somewhat passive. It is a very recession resistant type of item. It's not going to be going away anytime soon. I like to invest in things that are around for a long, long time. Whereas, like drop shipping is a thing that a lot of people like to get into, but it's highly, highly competitive because the barrier to entry is almost nothing, and the game changes so quickly, and it's just hard to be successful in something like that for any long time. Whereas real estate, I mean, you don't get more basic than renting out a box to the general public out there. And also, some people see this as a bad thing. I think of this as a generally good thing, is you need $20,000 to $30,000 for a down payment on a $100,000 house. So there is a pretty big barrier to entry that most people cannot get into, which is why you need to strive to get there. And check out that video I did talking about the tax benefits. The Wealth Elevator thewealthelevator.com/turnkey. And then reading into more of the business expenses, now you can start to write off things that you would have spent anyway, and being able to write it off, effectively getting you a nice 20 to 40% discount depending on what tax bracket you fall into there. And that's generally what the wealthy like to do, right? They like to flow their personal expenses through their business to be able to get savings there. And it's just a different way of kind of flowing your expenses that you would have done anyway through this mechanism. But it's not possible unless you have businesses or alternative investments. And that's another reason why I don't like investing through a qualified retirement plan mechanism, such as a 401k, IRA. If you want more information about this, check out our info page at thewealthelevator.com/QRP. Again, very untraditional based on how most people think about wealth building. But, trust me, a lot of this stuff I've kind of learned from more higher net worth accredited investors, meeting people face to face, figuring out what the best practices are. And, what I try and distill on this podcast is these best practices based on where you're at. And what I've realized and what you'll find in the coming floors is a lot of these strategies that the wealthy do are very implementable by anybody. But boy, are they very counterintuitive than what our parents taught us, what our friends and family are doing out there. You may have to put this section before that last. I'm going to add a little bit more about the taxes here. The cool thing about business expenses is, you can write off things such as like your cell phone, your computer equipment, supplies, and even your car. And, if you're interacting with people, vendors, clients, now you've kind of opened up the box for, meals and expenses. Now, I'll try and get into this much more in future podcasts. If you guys need a good CPA, always feel free to reach out to team@thewealthelevator.com for a referral to the folks that we personally work with. There's most CPAs just don't really understand this game of real estate and business expenses. Biggest reason is, it just kind of makes things a little bit harder for them and they prefer to do things the easy way. But, the easy way is not the best for you. And I'm a big proponent for educating yourself on why this stuff makes sense so you can kind of lead and work with your CPA. But unfortunately, most people, I would say 90% of you guys out there don't have very good CPAs that understand this stuff. And why would you, right? Because think about it. Why would you want to take financial advice from somebody who's not financially free, like a CPA who's still working that day job? I'm just saying. But anyway, in conclusion, like this floor one is your training ground where you're kind of learning your art of saving, budgeting, and you're starting to invest in rental properties and starting to build that foundation for the future wealth. You might even implement a legal entity for some asset protection. You're going to start to implement a lot of these tax strategies too that'll just keep growing and growing and building the good habits now, like keeping your receipts, writing it off, recognizing what you can write off to, get more of that type of stuff as expenses. It's all critical and part of the building of a sophisticated investor and getting more efficient from that tax perspective. So join me in the next episode as we explore the strategies to excel. Join me as we explore the strategies to extend to the next floor too. Until then, keep climbing. And if you guys have any friends, tell them about the Wealth Elevator because it is a lot cooler and fun when you've got friends doing this too. Because I think what you're going to realize, especially when you get to floor 2, floor 3, you're going to start to realize that your friends won't probably understand this stuff and you're going to be talking 2 different financial languages. I mean, friends are friends and I've got friends that aren't really into this, but we're just going to start to realize, and especially if you come to one of our events, right, you're going to start to realize that, man, it's really cool when you start to, get around people that are synergistic in these types of ideas and, these alternative investing strategies. Welcome to another episode of the Wealth Elevator podcast. Last episode, we talked about floor 1, which is mainly about getting your first rental property to get moving on this elevator. And now we're jumping to the second floor. Now, envision your net worth at a rate surpassing many individuals' expenses. Imagine your net worth crossing over the $1 million mark. At this point, you're getting about $5,000 to $20,000 of monthly cash flow from your investments or simply from your day job. A lot of you guys are able to make $200,000, $400,000 a year plus within your family household. Sure, you may spend $200,000 a year, but you're still able to save a good chunk of your money. Most of our clients on the first to second floor are saving $50,000 to $100,000 a year, which ideally you should be putting to investing, which will buy you more assets to accelerate your path to financial freedom. If you're here on the second floor, you're likely already an accredited investor, which is a high 6-figure earner making over $200,000 of income a year or the net worth of $1 million or greater. Now, this podcast is your guide to transitioning from hustle mode, trading time for dollars, to the elevated realms of the second floor and beyond. Let's explore this transformation here. Your asset allocation mix undergoes a sophisticated dance between cash flow and equity growth. Patience is key for larger equity growth, often unfolding over 2 to 5 years. Now, just using myself as an example, I graduated college in 2007, bought my first rental property in 2009, and then from 2009 to 2015, I just bought all these rental properties, all remotely. I had professional property managers, and I was still working my full-time day job as an engineer. Now, that was when I was on that first floor of this wealth elevator. And in 2015, I transitioned to the second floor by starting to invest in syndications and private placements. And I became a accredited investor by net worth $1 million or greater. Point here making is it takes a lot of time. And some people come to us They're already on that second floor. They're already an accredited investor, $1 million net worth or greater. They want to get into some investment that is a lot more scalable than working with little rental properties. And they certainly don't want to deal with tenants, termites, and toilets. They don't want to do all the value add type of nonsense and take on all that risk. They just want to find good operators to invest in and be as a group purchase with other people in a much larger commercial robust asset. But the hard thing here is you need to engage with other affluent investors, which reveals the best practices for alternative investment portfolios. This is what basically I did from 2015 when I finally got out of my shell and I finally met other accredited investors. Now, for me, it was tough because I didn't know any people who had $1 million or greater. My parents weren't like this. We didn't go to school with rich kids who had yachts and many, many pieces of land and rental properties and apartments. I kind of had to do this by kissing a lot of frogs, going to a lot of crappy real estate clubs, which, by the way, are a waste of time, in my opinion, because most of the people who are there are wholesalers, flippers, other non-accredited investors who are yet to get even on the first floor of the wealth elevator and buy rental properties. But if you're on the second floor, you're even another step beyond that. The key here is diversifying your real estate portfolio with a whole bunch of holdings of syndications and private placements. A lot of these minimum investments range from $50,000 to $100,000. And if you're able to invest in one of these deals per quarter, then that's 4 per year. And in 5 years, you'll have 20 deals. And if you've got $100,000 invested in each of these opportunities, 100 grand times 20, that's $2 million in assets. If you're on the lower end, investing $50,000 per deal, now you're talking about $1 million of assets invested. Maybe you don't have that now, but in the next 5 years, if you're certainly saving $50,000 to $100,000 a year, it's something that you could definitely do. Or maybe even consider taking a HELOC from the home equity in your house, which I call as lazy debt equity, not really doing much in there. You need to get that working. Or maybe you're somebody who's been doing the 401k for a decade or two and finally realize that that entraps you in the world of traditional investments where you quite frankly don't get very good returns from that. And you're really realizing that you're going to have to pay taxes on that at some point. And the truth is, it's probably better that you pull your money out of those types of retirement programs, pay the taxes now, while your taxes are much lower now than in the future. Call it a conspiracy theory, but by leaving your money in that 401k or that IRA, you basically give the IRS a blank check to tax you at whatever they want in the future. So security is becoming unfunded and the government entitlement programs are just getting more and more, and the debt is getting more and more in this country, that all signs point to taxes going up in the future. Therefore, you want to get your money out of those traditional IRAs or other what we call qualified retirement plan money is the official term. If you want to learn more about that and if you want to harvest some of the funds within your QRP money, go to our info page at wealthelevator.com/QRP to learn more about that, or maybe hop on office hours that we do and we can dig into your personal situation. Or what I would suggest is join the club. Go to thewealthelevator.com/club. And then once you're on there, what we do for accredited investors is set up a complimentary strategy call with myself, and we can get to know each other and it can tease out some of these specifics, because we really start to get into these personal situations. And at the end of the day, this is personal finance, but personal finance in a lot more advanced level. And you'll start to see this really transform after floor 2 and especially get onto the penthouse level. But for now, getting back to this second floor, you've got this prototypical 20 deal portfolio. You're getting all these 20K ones. It's pretty easy from a tax standpoint to just hand that over to your CPA. Most times you're going into these value add types of deals. That's the cool thing about syndications and private placements. It's not just simply a buy and hold rental property. The mistake I kind of made early on was I was just doing buy and hold. And today I call that strategy the buy, hope, and pray model, because you're buying something and hoping that it's going to go up. Now, sure, you're cash flowing and with the tax benefits all included, you're doing a lot better than the traditional investments, but you can do better. When you get on the second floor of the wealth elevator, you're finally able to access the value add component. What we mean by value add, one of the simplest forms would be we buy a 100-unit apartment complex, and as the months go by, we renovate a handful of those units, maybe put a new appliances, new paint job, new flooring, maybe just simply put $5,000-$6,000 of rehab into that one unit, do it a few times that same month, get new tenants in there and bump the rents up. We've value added that property. We've increased the net operating income of that asset and therefore increased the market value of the property. The way commercial properties are evaluated, what you do is you take the net operating income divided by the prevailing cap rate, and that is magically what the properties are worth. So you've got control over the net operating income by either increasing the income, which you can do that by increasing the rent, by doing construction, or you can decrease the expenses, one or the other, but both is increasing the net operating income. And that, very simply, is how you make money in value add real estate. It is a strategy that really takes life by the horns of the bull. Whereas the buy, hope, and pray strategy, you're really at the whim of the market going up and down. That said, real estate typically goes up in value, but when you combo that with the value add, you really take your own future in your control. And this is where you see the stronger returns in these types of value add types of business plans. Most of these value add projects could take anywhere from 3 to 10 years. Just taking somewhere in the middle of that 5 years, you can see why this prototypical 20 deals in 5 years allows these deals to go full cycle. And the magic starts to happen when you invest $100,000, you get $200,000 back in 5 years, and you redeploy that into not one more deal, but 2 deals. So it's like stock splitting every 5 years, and you just grow your portfolio. And you're also still working your day job and continually to augment your portfolio there. Obviously, there's a lot of investments and not one size fits all. It's not a rigid map, but you can see how this hockey stick grows, how your net worth grows by doing it this way, and all the while deferring taxes to the future, because a lot of these syndicated deals are able to utilize some of the more aggressive tax strategies such as bonus depreciation, utilizing cost segregations. When you're a rental property owner on the first floor, you're likely deducting the asset improvement value 1/27th of the value over 27 long years, which is great, which is going to probably knock out a lot of the income that you're making it sort of tax-free. But with the syndications and private placements, when you're getting into a larger commercial asset, you're able to justify paying $5,000 to $10,000 for a cost segregation study to give to the CPA to aggressively write off that property a lot quicker. In some cases, we're able to, instead of taking 1/27th of the value of the asset in the first year as a loss, we're able to take 1/3 of the value in the first year, and this creates a huge loss. This really empowers investors with these things called passive activity losses to now offset the passive income that they have in that particular project. And if your CPA is sophisticated enough to do a grouping election, now you're able to offset the passive income within the entire investment portfolio. That's it. Very basic, but you'd be surprised how many CPAs don't understand this stuff. So if you guys ever need a referral to the CPAs that we use, reach out, join the club, thewealthelevator.com/club, and shoot our team an email at team@thewealthelevator.com. I'm passionate about, unlocking this for a lot of people because it's worked for me and it's really changed my life. Some people are able to implement real estate professional status, a very common situation where you have a working spouse who makes several $100,000 and their other spouse can stay at home with the kids. And because they implement real estate professional status at that point, they actually net more money while the other second spouse not having to work and make a salary. It's a beautiful thing when you get really tax efficient and you're comboing with the right strategies here. And that's the wealth elevator trifecta, which you really start to activate on the second floor, which is getting into alternative investments, which is the deals. And what this does is unlocks these augmented tax strategies and tax benefits. I've seen people within our mastermind group saving $50,000 to $100,000 a year in taxes right off the bat. Obviously, these are people getting killed on taxes, right? Paying $100,000, $200,000 a year on taxes. These simple maneuvers that we can do to save them 50 grand. The cool thing is not only they save the 50 grand, but they can put it right into deals and make even more money from there. And when you combo with the third part of the Triforce here, the third part of the trifecta, which is infinite banking and accredited investor banking, which is our little spin on it, it's a very powerful trifecta, which I think that it can get people to where they want to be in a third amount of time. All three of these strategies are cool in itself, but put all together, that's when things really take off. The Infinite Banking e-course is free for investors who sign up for our club. It is in your guys' member portal once you guys sign up. The tax strategies are on the website there too at thewealthelevator.com/tax. There's also some other items within the e-courses that we have in the members portal. And as far as deal flow goes, I think that's the difficult part. That's the part that I found some difficulty when I made the switch back in 2015 and started to sell off my pain in the butt rental properties for these syndications and private placements. Because what you're having to do is vet operators. And when you're first starting out, especially if you don't know any other accredited investors doing this types of stuff, it can be a very daunting world where there's a lot of magicians and marketers out there who are doing these types of deals. And that's where we're big on education. We have an e-course that teaches passive investors how to vet deals. It is a bit lengthy, but people are throwing serious money at this. And so was I when I first started. Now today I have the people around where I trust and where I get a lot of my referrals from, where I do a lot of my due diligence through. But it wasn't always like that. And it's not going to be like that for you. We have events through the Wealth Elevator from our participants and investors, and we try and keep a pretty close-knit community. But in the beginning, you're not going to have that. And you also need to get yourself up to a basic prerequisite level of your deal knowledge. You need to know the basic things, like what's a pref, what is a reversion cap rate, the key things to look for in a deck so you can carry on a conversation. Basically, if you came to Hawaii, or this year we're doing our annual retreat in Las Vegas, if you came out and I sat you at a table with 5 other accredited investors, I need you not to embarrass yourself so you can finally get on a par level and start to build real relationships with other investors. That said, the people that we have in our community are cool people, and we have everybody helping everybody out, paying it forward. The whole idea of the wealth elevator is you ascend to the top as quickly as possible, as safely as possible, but send that elevator back down for the next guy, right? Help out each other. Let's build this community with solid people all going to financial freedom together. That's why you got to get yourself up to a certain level. That's what I hope to do on these podcasts and the e-course for those of you guys who do sign up for the free club and book that onboarding call with myself. You need to get out of your shell and meet other people and mix it up. Like, I'm an introvert. I do happen to get really passionate about this stuff because it really changes lives, makes a positive impact on the world. And I feel like that this is my way to give back to society. I also love money. I love investing. So this is something I'm actually really, really passionate about too. I turn into almost a different person when I start to talk about this stuff. Join the club, thewealthelevator.com/club. Get access to a lot of that free content so you can get yourself up to a certain knowledge level to meet our group. That group knowledge is very, very important because I see a lot of people coming into our community struggle with sort of been brainwashed with investing in 401ks and paying off our house. Most people coming in have bought houses and they pay it down diligently, and some even pay extra payments to it. You need to stop doing that because that's not good money management, in my opinion. You need to be utilizing debt and figuring out where your lazy equity is hiding. If you're not around other people thinking the same way, it can be a real uphill battle. This is why some people who are just not really open-minded to these types of ideas and thinking for themselves and really thinking through the numbers. If I take money out of my home and pay a certain rate on it from my HELOC, I could invest it somewhere else. Sure, there is some risk there. With risk comes reward. And there are ways to mitigate that risk by doing due diligence, getting yourself around the right community, especially if you're on this second floor. And the second floor is not financial independence yet. You haven't hit your end game. End game I define as anywhere from $3 to $6 million net worth. Some families of 4 have high spending amounts and bigger lifestyles. They may be on that higher end. Older couples who don't have kids they have to worry about sent through college. Maybe they've already sent them to college, maybe on the lower, especially if you live in a lower cost part of the United States. But if you're not to that point yet, you're on this kind of second floor where you need to still be aggressive and you need to deploy your capital to more alternative investments to get better alpha than what is out there in the mainstream traditional investments out there. We'll get into this a lot more in detail, and you can check out some of the older podcasts on this. Remember, wealth building rules aren't really fixed. Your goals will dictate on where you're at. If you check out the book, there is a table that sort of outlines based on where you're at. Again, if you're on the second floor, you're still trying to strive to getting to that net worth level of $4, $5, $6 million net worth. Sure, I do see when people get to $2.5 million and they're already maybe in a half a dozen syndicated deals. I think that is an inflection point where people start to see the progress getting to end game a lot faster, or they feel like they're coming downhill. You need to strive to get to that point. I'll be talking more about the higher level floors, what that mindset is, what you're doing for your taxes, what you're doing for your infinite banking at that point. And just know the whole construct of the wealth elevator is that there's different floors, there's different levels to the wealth elevator. And this is what's hard at some of our events, where there's complete trust within the clientele to basically put your name and your net worth on your name tag. Sometimes you do need that context. 2 investors could be talking, but if one person who is $1 million net worth in their 60s is in a totally different place than somebody in their 40s with a $3.5 million net worth closer to end game, meaning that that person may be investing a lot more conservatively, or even that older person who is at $1 million net worth, they need to be more aggressive. That also brings up another point. I don't care how old you are. Your age means nothing. To me, your carbon date is where your net worth is, and that sort of dictates where you are in terms of the net worth. And what overlays on top of that is what is your personal consumption levels and your spend rate. And that dictates on where you fall in this paradigm. And that's why we urge you guys, build a relationship with us. A lot of this stuff does become personal finance. And that's why we do those free onboarding calls for new investors coming in to really calibrate where you are with a subset of, investors, you guys listing here, that are a little bit more advanced, or actually a lot more advanced than the average person out there, that are still trying to save money on a monthly basis from their personal finances. To close out the podcast today, we will get into it a lot more and talk about some of the higher level floors coming up. If you guys like these podcasts, reach out to us, join our club, thewealthelevator.com/club, and we'll see you guys next time. Welcome back to the Wealth Elevator podcast. If you missed the first few episodes, we talked about the basement, the first floor, and the second floor of the wealth elevator. And today I'm going to be going into the penthouse level and beyond. We launched this podcast back in 2016. Back then, I was on that first floor of the wealth elevator buying little rental properties. From 2016 to about 2020, going through the second floor of the wealth elevator, where most people will get rid of their rental properties or start with syndications and private placements as a passive investor. And this is really where a lot of these other tax strategies that we talk about and infinite banking, accredited investor banking comes into play. But what happens when you get past this point that I call endgame. Now, endgame is defined as basically a point where you got enough money, where your money just grows on perpetually. So people call this the critical mass point, or if you think about a rocket shooting out into outer space, it's when it breaks the atmosphere and essentially goes zero gravity. Now, that is more of a metaphorical term. Let's define endgame. Once your passive income has surpassed ten to $25,000 per month. Now, why the big range? We have some people within our community that have older kids where they've graduated college, they're off on their own feet, and they are now living pretty frugal lives. Maybe they live outside of high price areas like California, Hawaii, New York, and they survive under five figures of expenses. Now, if you're like most of our clients who family of four or family of five in a high priced area where you still have the unknowns of how many years are these kids going to go to college, you may be needing $15,000 to $25,000 of passive income a month. And when you apply the old 4% rule, which is a very conservative number where somebody can invest in traditional investments. Again, traditional investments are retail investments that we tend to stay away from. But once we hit this penthouse level, we tend to go back to more liquid and traditional investments. Now, if you're somebody on the first few floors of the wealth elevator, definitely under $3 to $4 million net worth, put your earmuffs on, or just listen in on this conversation of the penthouse and beyond, and just know that you're not there yet. Now, I haven't met too many people. In fact, I haven't really found anybody yet who wasn't born with the money. So most of our investors are first generation millionaires. So the first person in their family to hit $1 million net worth, not given it by their parents. And for a lot of those people, unless you invest in more than a quarter to half of your net worth into alternative investments, to me, there really is no way to get to financial freedom, meaning to hit this end game level of $2 to $4 million. Again, if you're somebody who breaks this mold, book the call with me. I'll buy you a beer if you defy all these odds. But there's basically two kinds of people out there, right? People who invest this way, where they're investing off of Wall Street, getting the tax benefits and essentially cutting through all this drag of taxes and also using infinite banking to their advantage. And then there's the rest of people. Just take a standard age of 50 years old. If you're 50 years old and you've done everything right in the traditional way, I really don't see too many of those people over $1.5 million, $2 million net worth. But if you are taking advantage of this trifecta of strategies we've been talking about, which we'll talk about more in the future podcasts, the net worths are often 2 to 3 times greater than what the person is doing on that traditional path. And this is why I'm so passionate about sharing what I've learned from other accredited investors implementing these strategies that we talk about. And again, getting back to in-game level. Now, if the 4% rule, 5% rule confuses you, let's just, for discussion purposes, let's just call endgame for most people hitting about $4 to $5 million net worth. Now, once you've surpassed that level, you're probably on what I call the penthouse level. You've got all your bases covered in terms of livelihood expenses. You're able to go on amazing first class vacations and getaways, and you're probably not trading time for money anymore. At this point, your investor mindset is about legacy planning and educating the next generation. When you start to interact with a lot of our accredited investors within our ecosystem, you start to realize that a lot of people in our world are very family oriented. And if you've got a net worth of several $1 million or greater, you're probably not thinking about living paycheck to paycheck or investment to investment. And you're starting to thinking more long terms, potentially multi-generational. And I've always joked around with my inner circle family office clients where, if you've got more than a couple $1 million net worth and you've got more than 2 kids or more, giving them more than $1 million each is actually a disservice, because you give them that much money, they're just going to blow it. What's really the most important thing is the education of all these financial ideas of using good debt and leverage, understanding risk tolerances. And I think the big thing that we offer people in our ecosystem is that network of other passive investors thinking in this type of prudent way. and oftentimes aligned with the same value structures. Now, once you hit this penthouse level, as I said earlier, you may go out of alternative investments to some respect. That said, a portion of your portfolio may be seeking non-correlated assets. So non-correlated assets, and I talk about this more in the book in detail, are types of assets that aren't really impacted what's happening with the economy. Now, the economy goes up and down. That's how it is. But if you can find investments that aren't really impacted by that very much, some of the more popular ones you see a lot of like life settlement investing and other investments, like in the world of real estate, for example. Some investments are very contingent on what's happening with interest rates because leverage is a big part of real estate. But then within the world of real estate, there are other investments such as land royalties, triple net leases, leaseback sales, aren't really talked about too much. And part of that is they're not really for the investors on the first, second floor of the wealth elevator because when you're on those levels, you're going to need those double digit returns to get yourself up to this penthouse level. And therefore, when you get to that penthouse level, you can take your foot off the pedal to some respect. So there's this phenomenon that I felt a little bit uneasy about personally because how else did I get my net worth to where it is today to get to the penthouse level? But I went into almost 100% alternative investments. And once you get to this penthouse level, to have this idea to take your foot off the pedal and to go back into traditional investments made me scratch my head a little bit. But then again, this is my role for our organization is to always stay one step ahead and be interacting with those higher net worth investors for you guys. Again, I'll say it. When you're in the first, second floor of the wealth elevator, trying to get your net worth above $2 to $5 million net worth, you're going to need a high concentration of alternative investments. I would probably say at least higher than a quarter to a third of your net worth. And that may seem very uneasy for you, especially when you're just starting out. But, what I see from most of our clients, they'll jump in with maybe 10% of their net worth, which it might be several deals, see how it is for the first several years, and then ease in on the next go around, especially once the deals start to go full cycle. I talk a lot about this process of what I see from other investors in my book. And we also have another framework within our accredited investor infinite banking e-course where you go and you load an infinite banking policy and you take the proceeds of that and you roll it into deals. And especially if you're going into high cash flow type of investments, you're able to create that quick cash flow stream and to build this cycle. And that can be a great way if you're new to this world to build good momentum for yourself and to slowly move into a higher concentration of alternative investments. Now, everybody is a little bit different. I'm not going to say you have to go over 33%, 55% of alternative investments. But to me, again, just looking from all the profiles that I see, and I talk to all of you guys, we ask for you guys to fill out the onboarding form so I know and I don't waste your time, I don't waste my time giving you the best personalized information that I can give you. And from that, I had this huge data set of probably, I think we have well over 12,000 people within our database to pick out the best practices and what is working. So again, if you guys want to join our group and have that quick sit down with me, you can go to thewealthelevator.com/club, get signed up there, and then book your free onboarding call with myself or the team, and then we can get you pointed in the right direction. Just to round out the penthouse level, again, at this point, you're good. You're thinking more about the future for other people, your future generations, and you may even be in a place where you're looking to give back. And this is what makes me very passionate about the wealth elevator and the whole concept of sending the elevator back down for others. I got to this point in 2020 myself, and I've been building the Wealth Elevator project since 2016. And I was like, what's next, right? Am I just going to keep investing? And what I discovered was my calling. People call this your ikigai. And if you Google that term, it's the intersection of things you're good at, things you find fun, things that are good for the world, and things that you can somewhat monetize. And monetizing means it's just not just for money, but it brings value to people. When people pay you money, that means you are actually providing good utility into the world. If you can find something that hits all four, this is your ikigai. And I think most people never get a chance to truly discover what their ikigai is because they're too busy trading time for money at their day job. Look, I had to do it, and I think everybody needs to do this. Luckily, most of our offspring will start off in the penthouse level and beyond and never have to do this. But it is what it is. Some people are just born from the lucky sperm club. But for a lot of you guys listening right now, and I think what makes our group so rich are a lot of first generation millionaires who are very prudent with their money and willing to get off of that beaten path and try something different, but try something that makes a lot of sense here at the same time. When you get beyond this $10 million 8-figure threshold, it starts to become a lot of tying into things that make you happy and passing it forward for other people. My calling was financial freedom and financial education, teach people how to get their finances in order. But for you, it might be something totally different. I think what's the cool thing is money gives people options. And this is where I urge people where they want to be in a third amount of time. They can use that 2/3 of the time that they would have spent helping out other people. So if you're somebody who wants to get more involved in our community, or at least just help out your friends get their finances in order, hopefully you'll see this as an opportunity to send the elevator back down to others, whether they're in the basement floor or starting out on the second floor. Go ahead and get us connected with our team and we'll get them onboarded. But this may mean just unlocking something that is passionate with yourself. From what I've discovered from a lot of our clients who've retired, I feel like you need about 3 to 6 months away from your day job, that space to create that cognitive freedom to be able to search for what really makes you happy. And at the end of the day, we're all searching for happiness. But what happens when you hit 8 figures and above? You may or may not stick with the investments that got you here, right? The value add businesses or real estate that got you much better alpha returns and great tax savings. You may go back to traditional investments. So this is something that some of the higher net worth individuals within our family office group is doing using the security backline of credits. We have other curriculum at our website. We'll have future e-courses on this topic too. But this is what happens after you've hit this end game point. I'm not going to go into the myriad of different ideas, but we have a whole chapter, I believe chapter 11 in the Wealth Elevator book that does a quick hit on all these types of ideas. I think what really brings this stuff alive is when you're aware of it and then you meet other people and you ultimately join our family office group and our mastermind with the multiple 7-figure guys. And you start to talk about these ideas and how they're implementing it and how you should implement it if that's what you'd so choose. Now, there is another floor after the penthouse and the rooftop. This is more when you get into family office type of thresholds of $50, $100 million net worth and greater. Now, most people within our ecosystem are not in this realm, nor do they want to be in this realm. Now, it takes a unique kind of person that wants to keep going and going after 8 figures. Now, I am around the vicinity of a lot of these types of individuals, and I gotta admit, they're a little bit kooky. But at least like my whole thing is to bringing some of the insights from those types of people to us. The big thing I wanted to get through the Wealth Elevator book was this whole idea of at least get yourself up to $4 to $5 million net worth. I think it seems like a lot of money by most people's standards, but within our community, $4 to $5 million is a confident, modest position that you need to be striving towards, at least to set up multi-generations behind you and to live a life of pure abundance at that point. If it seems like a lot to you, then that's great. Maybe you're somebody who needs to shoot for just $2.5 million. My big message that I want to get to everybody listening here is figure out what your burn rate is and let's race and quickly get up to that point. And once we get to that point, let's get into cruise control and focus on enjoying life than saving or investing our money. It's this whole concept of being in cruise control or riding the roller coaster when you know you're on the rails going to where your destination is. There is no better feeling than knowing you're going to win the game. You're already up 7 touchdowns and to enjoy that late third quarter, fourth quarter of the game, knowing that you can cruise it in and savor every moment than to living in scarcity mode up until the end. We never know when the end is going to be. And the quickest you can get to a point where you've freed yourself up and you've hit the finish line, for some, they need to get to that point so that they can truly start to enjoy. I know there's a lot of programs out there that teach gratitude and abundance. I don't know. I think that's great. I just feel like until people have enough in their bank account and enough in the net worth column, that it's just really hard to really embody that true abundance mindset. Now, we try to create the ecosystem where people have peers that help them get there, but let's get your net worth and progress you through these floors of this wealth elevator. Hopefully, you guys would like to join me on this journey. Either way, it makes it a lot more fun. So, again, enjoy the future podcasts. If you guys need any help, please reach out, team@thewealthelevator.com. And if you guys have any friends that want to go on this journey with you, please let us know and we can get them onboarded.
Join our community on their wealth building journey with the Wealth Elevator. If you've been a listener of the Simple Passive Cashflow podcast since 2016, you witnessed my genesis buying little rental properties to now over $2.1 billion in assets as a general partner. Along the way, I uncovered a 3-step system. Step 1, syndicated deals, where you bid farewell to 401k plans with traditional investments and deceitful operators as you make your way into the alternative world. Say hello to genuine opportunities as I invest alongside you. Step 2, unlocking passive losses. Ditch those 401ks or Roth IRA strategies for the average Joes. Discover the secret tax strategies of the wealthy, where most of our clients are able to lower their tax bill by 20 to 50%. And finally, step 3, mastery of infinite banking by making money in 2 places at once. For those net worth who haven't hit 1 million, go into my free turnkey rental course at thewealthelevator.com/turnkey. Now let's get real. If you're an accredited investor who is searching through countless books and podcasts, my 1-2-3 system is your key. But remember, this journey is about a community of passive accredited investors like ours. Plug in, join our investor club, and unlock unparalleled investor access at thewealthelevator.com/club. And for those poised to deploy over $250,000 their first year, or got a net worth of over $2 million already, join our exclusive inner circle. The Family Office Ohana Mastermind awaits.
So why are you rebranding? Well, I always got a lot of criticism for that really strange green flubber looking thing. So we thought it was about time to make it a little bit more grown up and turn it into different hues of blues. The whole idea behind it came out of the new book, The Wealth Elevator.